The average true range, or ATR, is a technical indicator that shows us the volatility of price over a given time frame. It is calculated by averaging the price movement over a period, which essentially levels out the spikes and dips in price to provide a more holistic view of what the true price is, or in other words, the price's true range. This true range is calculated by finding the difference between the previous close and the current price, high or low. While ATR is a good measure of volatility, it's important for you to understand that it is not a trend indicator. In other words, it doesn't exactly tell you where the market is heading. However, it still remains a great indicator of volatility, and many profitable traders still use it to manage their trades effectively. Let's dive deeper into the details of ATR and how it is derived. It may be helpful for you to understand that the ATR essentially functions like a moving average. A common time period used to calculate ATR is 14 periods, or 14 candles, which gives us a good view of a particular chart's volatility. This can be applied to charts of any time period, be it hourly, daily, weekly, or monthly charts. In the above picture, you can see a tab that labeled Smoothing. This refers to how the average is calculated, or what type of moving average is used. If you recall, you can choose between the exponential and simple moving averages, which we discussed in our chapter on moving averages. These are the most common averages used by traders. As for the length, this refers to the number of time periods. You can choose your time period based on the time frame that you want to measure. When measuring recent volatility, you can use shorter averages such as 2 to 10 periods, while longer-term volatility can be measured using 20 to 50 periods. You may also see that there's a small number near the indicator. This tells you the average number of pips moved in the past period according to the time frame the ATR is set to. Because ATR is a volatility indicator, it would preempt traders on how wide the price movements will be in the market based on how volatile it is. This will be a good indicator for us to know where to place our stop losses. When the ATR reading is high, it signals to us that the market is experiencing high volatility at the moment. Thus, we can expect much wider price movements. You can use this signal and decide to set your stop loss further away in order to avoid getting stopped out prematurely. Likewise, when ATR is showing us a low reading, it means volatility is low, thus you can afford to use a smaller stop loss. This is similar to using a volatility stop, which is another indicator used in technical analysis. Now let's compare the ATR readings on two different markets and see how we can adjust our stop losses accordingly. In this image, we can see that USD in the daily time frame has an ATR reading that shows us an average of 73.1 pips movement in a day. And in this image, we see that the ATR for GBP USD is 123.8 pips in the daily time frame. This means that GBP USD moves 1.66 more than USD on a daily time frame. Hence, it would be wiser to use a larger stop loss when trading GBP USD. Setting your take profit levels is similar to how you set your stop loss levels using ATR. Essentially, you should find out how volatile the market is to determine how far you should set your take profit level from your entry price. In a volatile market with high ATR readings, you would be able to aim for a larger profit and maximize the market move. Hence, you can afford to set your take profit level much further from your entry level. Likewise, in a less volatile market with low ATR readings, you should adjust your take profit to be closer to your entry level so that you don't miss any move in the market. The ATR can also be helpful as the last step in determining whether you want to enter a particular trade, regardless of what direction you hope the market will move in. That being said, using the ATR as a trading strategy in isolation is not recommended. Instead, you should look to combine it with other technical indicators to validate your idea. This topic is over. Don't forget to like, subscribe, and turn on the notification bell so you're the first to know when the next video on parabolic stop and reverse (PSR) is released.